Hey folks, hope you're well. I wasn't planning on putting out another video quite so soon after last night's DXY update, but I was talking with a few other analysts this evening around how the monthly ties in with an article that I wrote recently for my website titled Game of Fractals. I'll put that on screen just so that you can see it, and I'll link it in the description if anybody wants to read through it. The premise for that article was looking at the last 100 years or so of data for the US equities market, the SPX and the Dow mainly, mapped out around the 4-year presidential cycles, which is the larger 4-year cycle that I believe personally that Bitcoin slotted right into, and why Bitcoin follows a 4-year cycle itself. I think it's the same 4-year cycle. So that article that I put together was built on top of something that I read from Mike Siccardi, who's another analyst. That I'll put his Twitter link on so you can read his Twitter stream if you fancy. But when I started going back and having a look at the data myself in order to build a case for the 2008 fractal not being the right comparison to this year, in my opinion, when it started to become popular on social media, or certainly my social media, I saw a lot of people comparing 2008 to 2022. And ultimately, I don't think it works because the time element, a time and price, is out. 2008 is basically out of step with that larger 4-year cycle that I'm referencing. 2008 was a year 4, where we're currently in year 2. Now, in general, I'm not a fan of fractals. But the best recent example I could find around financial markets and the macro situation that we're in at the moment is more likely 2002 than 2008, as it fits a little bit better with both time and price. And it's a bicentennial year, so 20 years of that, or 5 sub-cycles of that 4-year cycle to now. So the aim of this video is to look a little more detail at that, alongside the monthly view of DXY that I covered last night, because there's some confluence there, should DXY start to break down for here, that might point towards that 4-year cycle being something we want to look a little bit more deeply into. So I made clear last night that I still favoured up as the higher probability on DXY to the 117 to 120 range. But also made it quite clear that that's based on the structures from H4 up to the monthly all being in bullish confluence, and that my invalidations started with an H4 range low break, followed by the daily and then the weekly, which is the same range low. The H4 range has been tested quite well today, so with that I wanted to cover a little more about this and bring the article to life a little bit alongside it, just as a thought experiment around what could be to come should both the 4-year cycle and DXY top theory play out together at the same time over the next 6 to 9 months. First up, let's cover the data from the article. I'm not going to go into full detail on this and reread the article. It's there should anybody want to look at it. But at a high level, since 1928, which is all the data that I've got, the US equities markets have followed a pretty common pattern wrapped around the US 4-year presidential term. This chart shows the general pattern of these cycles, which is up in year 1, down in Q1 to Q3 year 2, a bottom somewhere in Q4 for midterms, and then a positive return up to the end of H1 in year 3, some consolidation or a pullback, and then up into year 4 in the race for the Oval Office. This has generally led to a positive return in Q4 year 2 into H1 year 3, which is where we are now. We're in Q4 year 2 now. And that's happened in 21 of the 23 cycles that we've got data for, dating back to 1928. So the last negative return in this time period that we've currently entered was 1938. And if you look at the aggregated data for year 2 in this chart, it shows that in general we're always kind of sideways or down through Q3, just like we've seen this year before we've gone into Q4 and we've started to see some positive returns. So as we can see then for those two charts, we're reasonably well on track for that 4-year cycle in terms of the shape of the charts and what we've seen so far in Q1 and Q3 this year, and certainly the start of October for Q4. If we have a look now at the raw numbers, which I'll stick up on this slide, you get a better idea, I think, of why I'm looking at the historic 4-year cycle for equities as something we want to keep an eye on. So in terms of the numbers themselves, as I said earlier, there have been 24 instances so far, or we're in instance 24, 23 complete cycles over 96 years so far. Q4 year 2 and H1 year 3 has been a positive return on SPX and Dow, 21 out of 23 of those completed cycles, so 91% of the time we've seen positive returns during this time period from now to the end of June next year. The average Q4 year 2 to H1 year 3 return is 15.9%, and that's if you include the two negatives and all of the negative return Q4s as well as the positive return Q4, so that's an overall average of 15.94%. The average Q4 year 2 to H1 year 3 return on the decennial year, which is the every 20 years basically, which is what we're in this year as a 20-year cycle, has been 30.49%. So if we look at those in terms of a potential range that it might give us, just to play it out as a thought experiment, if this were to follow through, it would tell us that we're looking at somewhere between 41.68 and 47.25 as a range for where the SPX might go should this play out at an average of the last 98 years worth or 96 years worth of data. What does this have to do with DXY then, and the monthly chart that we had from last night at the end of the overview video? Well, if we're going to see this cycle repeat, it's certainly not going to do it with a bullish DXY making new highs. It needs DXY to top, even if that's a local top, at some point in Q4 or potentially already, as we discussed last night, and then start retracing into a low somewhere in that monthly range over the next 6 to 8 months. So basically from now to the end of H1, we would be looking to see DXY in a retrace of that monthly range as a worst case. The DXY could still then return to bullish posture after that. It could be a retrace into a point of interest within the range and then go on to break that range high, which would decimate any returns between now and the end of H1 next year. But certainly if we are to see this cycle play out in terms of just the specific Q4 into H1 year 2 into year 3 element of it, we need to see DXY pulling back. And as we discussed last night, it is a legitimate area we could look for a top in DXY on the monthly, and a pullback on DXY at a monthly level is going to take a number of months in order to pull back into a reasonable area in the range. Now, I mentioned last night that the previous range high here at 103.87 was a decent place to look at to begin with, because previous range highs and lows are always points of interest. But we also have this fair value gap here between 101.2 and 99.45, which I think is a better interest point because it's below the equilibrium point of the range, and that's generally always something that I would look for personally. You can then start looking at 618 retracements and through to 786 retracements, but initially I think those are the two main areas to look at. There is this order block that's sitting just above that at the top of the fair value gap, but again, it's not below the equilibrium point of the range, so I would prefer to be looking for that 99 to 101.2 kind of area. So if that is to play out on DXY, then it could well be the precursor to that positive return that we've seen over the last 96 US presidential cycles into June next year, and we could be looking at a bullish drive on risk assets, so the SPX, the Dow, Nasdaq, Bitcoin, basically across the risk field. Now, as I said earlier, I've still been bullish on DXY structure because nothing had broken. From H4 up, everything was looking bullish, along with the daily and the weekly and certainly the monthly. But the reason for putting this out today and as a thought experiment in terms of where this could go, if we drop down and look at the H4 for DXY, and I'll just get the H4 structure on. The H4 structure broke to the downside during the day today, so we now have a legitimate break with closure below range low, so back to neutral from bullish posture from the H4 on Dixie. We're looking for a low to be set here, and then a pullback somewhere into the new range, and then a continuation drive from that towards the daily range. So the daily range at the moment is there. So the daily range low sits at 107,689, and that's also the weekly low. The weekly and daily range are the same. So in terms of this playing out over the longer term, the moves on Dixie at the moment, in terms of that break of the range 4 low, suggests that we might well have seen, if I skip to the daily, we might well have seen a failure swing there on daily from an attempted bullish drive, return to bearish posture for the H4, and an attack on daily low. So it's certainly possible. We could be seeing the beginnings of the slow turn of the Dixie Titanic at that monthly level, starting on the H4, that would see over the next 6 to 8 months that 4-year cycle, that historic 4-year cycle on equities and risk assets play out again. Certainly the Q4 to H1 positive return part of it anyway. So it's possible. As always, I'm not putting this forward as this is what's definitely going to happen. I don't deal in certainties. I'm just saying it's possible at this point in time based on the data that we've got and the structure that we're seeing change on Dixie and across the risk field at the moment. Invalidations are still, for me, on the Dixie chart. I think that's the important chart at the moment, given the focus on rates and bond yields and CPI. So the key range is still the H4 on Dixie. So it's broken the low. We're looking now for a low to be set, give us that new H4 range, and then what does that H4 range do? Does it break again, confirming the bearish reversal? Does it attack the daily low and confirm that reversal on the daily from a daily perspective? Because if you look at this daily chart here, if we were to go and attack that low from here, it would be a break of structure following that failure swing. So certainly it's something we need to keep an eye on, and I think the H4 range break today could be that first sign of structural alignment between Dixie and that historic US presidential 4-year cycle. So just something to think about, something to look at. Numbers are all there. You read the article, have a look at Mike's stuff, have a look at the charts yourself, map it out, see what you think. It's something that might play out, might not play out, but it's quite an interesting thing in terms of the data, or I thought it was interesting in terms of the data and how things are playing out to potentially come into alignment for that bullish drive into next year. So that's it. Thanks for listening as always. If anybody's got any questions or comments, stick them below and I'll get to them as soon as I can. Until next time, stay safe. My tea's it. Gotta go.